Okay, real talk. You've got cash sitting in savings at 4.5%. You're thinking, I'll wait for the crash. Why buy high? I'll buy low when it crashes. Here's the thing, that voice has cost people millions. Not an exaggeration. I'm a data nerd, not a financial advisor. I've spent years reading Charles Schwab research and behavioral finance studies. I don't make money if you invest or sit in cash. But I do care about you not shooting yourself in the foot. Here's what we're covering: why the best market days happen right next to the worst days, why waiting for a crash is expensive, what actually happens when people try to time the market, and the one strategy that actually works, without requiring you to predict the future. First question, do you know what the market will do next Tuesday? Charles Schwab did a study. 20 years of data, 2004 to 2023. Here's what they found. If you invested $10,000 and never touched it, you'd have $47,000 at the end. That's 370% returns. Now, what if you had a crystal ball and avoided the 10 worst days? You'd have $72,000. That's the fantasy of perfect timing. But here's what matters. What if you missed the 10 best days? Your $10,000 becomes $18,000. That's 80% returns instead of 370%. You lost $29,000. On $1 million portfolio, missing those 10 days costs you $290,000. This is the trap. The 10 best and 10 worst days aren't separated by months. They're separated by days, sometimes hours. You get the crash on Tuesday. The recovery rally starts Wednesday. You're sitting in cash. You miss Wednesday. Concrete examples: March 2020. COVID crash. Market down 34%. But the 15 best recovery days happen in the next 3 months. If you sold March 15th and bought back June 15th, you'd have locked in the wrong decision. December 2018. Market drops 20%. Everyone's predicting another 2008-style crash. But then January and February have the best gains. If you waited out January, thinking this recovery isn't real, you'd have missed the exact moment the trend reversed. Brexit. Surprise vote in 2016. Market closed in panic. Reopened down another 4%. Everyone's selling. But the best single day of market gains in 2016 happened 2 days later. A Wednesday morning, you're sitting in cash thinking it's going to zero. The market's up 3% that day. One day. You miss it. Here's another way to look at it. Missing just the 10 best days out of 5,000 plus trading days over 20 years, that's 0.2% of days. Costs you 40% of your returns. Think about that. And it gets worse because the best days cluster with the worst days. You can't have one without being exposed to the other. Here's the mechanism. The market doesn't rally on boring days. It rallies when fear turns to hope. When people think they made a mistake selling. When news is better than expected. These moments happen in volatile, scary markets. Markets where people are terrified and selling. That creates the opportunity for rallies. 2008 example. Market bottomed March 9th, 2009. Down 57%. If you sold in January 2009 thinking, this will go to zero, you'd have missed the next 3 years of the best market returns in history. But here's the human part. Things weren't calm in March 2009. Banks were still failing. Unemployment was climbing to 10%. News was still terrible. But the market was already recovering. The recovery wasn't visible under the news noise. It just happened. Same with COVID. March 2020, markets down 34%, unemployment exploding, hospitals overflowing. Conventional wisdom says wait until there's a vaccine, wait until things are normal. But the market had already started recovering before the vaccine existed. Because the market prices in 12 months ahead, not today. The pattern. Bad news, market drops, fear. Investors sell, market bottoms. Smart money buys, momentum shifts, news finally catches up, market already up 20%. During major corrections, 10% plus down since 1980, average recovery is 4 months. But here's the key. 50% of the recovery happens in the first month, the month when everything feels scariest. If you're waiting for things to feel right, you're waiting for month 2, 3, or 4. By then, the money has already been made. This is why market timing fails. The moment that feels safest to invest is usually when the best returns are behind you. The moment that feels scariest is usually when the best returns are ahead. Real investor behavior data from Vanguard and Morningstar. People actively try to time the market, and they fail spectacularly. Here's the pattern. Market up 3% year to date. You think I'm getting out. You sell. Feels smart. Market goes up 5% more. You think I made the right call. You wait. It keeps going up. Market's up 8%. Now you panic. You think if I don't get back in, I'll miss everything. So you buy. At higher prices than you sold. You feel worse. Market pulls back 6%. You panic. You sell again. Now you're down 3% from your original sell. Rinse, repeat. From 2009 to 2019, the S&P 500 returned 16% annually. The average stock mutual fund investor returned 5.5% annually. Same market. Different decisions. Morningstar found that investors pour money into funds right after great years buying high and pull money out after bad years selling low. Exactly backwards. Concrete example. $100,000. Investor A holds S&P 500 for 20 years. Doesn't touch it. Ends with $470,000. Investor B tries to time the market. Misses the 10 best days but avoids the 5 worst days. Ends with $180,000. Same person. Same market. $290,000 difference. That's the difference between retiring at 60 and working to 75. And Investor B actually made some good calls. They avoided 5 worst days. But it didn't matter because they missed 10 best days. Even when you time some things right, missing a few key days destroys the math. There's a concept called market scars. It explains why people end up poor despite good earning power. You experience a major crash. 2008. 2020. You see your portfolio cut in half. Maybe you don't sell, but you watch it happen. That's a scar. It stays with you. Studies tracked people who lived through 2008. Even if they held and didn't sell, most became more risk-averse for life. They held less stocks, more bonds. Over the next 10 years, while bonds earned 2% annually, stocks earned 15%. That 30% asset allocation difference cost them hundreds of thousands in retirement. The scar changed behavior permanently. People who actually sold at the bottom experienced the loss twice, watching the drop and realizing they sold at the worst time. Many never felt comfortable being fully invested again. Key insight: the people who get scarred stay out of the market or reduce exposure. The people who never lived through a crash, who started investing after 2009 or 2020, get to compound for longer at higher stock exposure with fewer emotional hiccups. Starting early beats timing perfectly. 2 people, age 30, both get $50,000. Person A invests immediately, holds 35 years to 65. 10% annual returns. Ends with $1,974,000. Person B waits 5 years thinking crash is coming. No crash. Gets scared missing gains. Age 35, finally invests. Holds 30 years. 10% annual returns. Ends with $885,000. Same returns. Same market. Person B has $1.1 million less for waiting 5 years. The market crashed 20% plus from peak 76 times since 1980. It also recovered 76 plus times. For every crash, there's a recovery. The people who experienced 74 recoveries made vastly more than people who sat out waiting. You don't have to be right about timing. The market just has to be right about recovering, and it always does. Eventually. Time in the market beats timing the market because it doesn't require you to be right. It just requires patience. What actually works? It's boring. So boring you'll think I'm wrong. It's called dollar cost averaging DCA. Here's how. Stop trying to figure out the right price. Ignore price completely. Invest a fixed amount on a fixed schedule. Every month, $500, $1,000, whatever you can afford. You don't look at the market. You automate it. Why does this work? 1. Removes the decision. No more is now a good time. It's automated. You can't second guess yourself if there's nothing to decide. 2. You buy more shares when prices are low. When the market crashes 20%, your $1,000 buys 20% more shares. When the market rallies, your $1,000 buys fewer shares. You're mechanically doing the opposite of what human psychology says. You're buying fear without even trying. Example, 2019 to 2020. You DCA $1,000 per month for 24 months. Total, $24,000. January 2019 to January 2020. Market up 30%. You're averaging $923 per share. March 2020, crash. Market down 34%. Your $1,000 buys 20% more shares. You're accidentally buying the dip. January 2021, recovered. You're up 45% on $24,000 because you kept buying through the crash. Compared to lump sum $24,000 in January 2019. Market crashes. You panic. You sell at the bottom in March. You have $16,000. You sit in cash. You miss the 46% recovery. You have $16,000 while the DCA person has $35,000. Vanguard data. Over all 20-year period since 1980, DCA beat lump sum 70% of the time. In down markets, 95% of the time. In up markets, it lost 65% of the time because you weren't fully invested at the start. But overall, DCA came out ahead because it was so much better in crashes. The math. In crashes, you buy cheap. In recoveries, you're already invested. The upside of buying cheap in crashes is bigger than the downside of not being fully invested in rallies. If you have $50,000 sitting in cash now, don't try to time when to invest it. Invest $5,000 per month for 10 months. If the market crashes, you're buying 40% of your allocation at cheap prices. If it goes up, you're capturing most of the gain. Either way, you're not wrong. The person who DCAs $50 K over 10 months beats the person trying to time the perfect entry 99% of the time. Not because DCA is genius, because timing is impossible. This works because it removes the expensive part of investing, being emotional. You're not trying to beat the market. You're trying to not lose to yourself. I know the objection. What about 2000? What about 2008? Timing those would have made way more money. True, technically, but you didn't time them, and neither did most people. In 2000, tech was overpriced, but the crash didn't hit until 2001, and it lasted until 2009. If you sold in 2000, you felt smart for 2 years, then stupid for 8 years watching the recovery. In 2008, banks were failing. Selling made sense on the data, but the people who made money weren't the ones who predicted the crash. They were the ones who bought in 2009 when it was terrifying but cheap. Basically, nobody did that. Even when crashes are predictable in hindsight, they're not predictable in real time. Here's survivorship bias. One person predicts the crash and gets on CNBC. You remember them. 100 people predicted the crash and were wrong. You never hear from them. You only see the winner, so you think timing is possible. It's not. Professional investors, whose job is to beat the market, underperform buy and hold indices 95% of the time. If they can't beat it, you can't. The solution isn't to try harder. It's to stop trying. Do something basically impossible time the market, or do something basically guaranteed invest consistently and hold. Boring almost always wins with money. If you're convinced, here's the actual plan. Step 1, open a brokerage account. Vanguard, Fidelity, Schwab. Doesn't matter. Step 2, buy a total market index fund or S&P 500 index fund. No stock picking. No stock rotation. Just the whole market. Step 3, calculate what you can invest monthly. $100? Fine. $1,000? Fine. Consistency matters more than amount. Step 4, set up automatic investments. Every paycheck, a portion goes directly into your index fund. You never see it, so you never miss it. Step 5, stop reading financial news. Turn off CNBC. Unfollow financial influencers. The more you check, the more you'll trade. Step 6, check your balance once in 10 years. That's the entire system. Your reaction might be, this is too simple. There must be more. That's your brain trying to reassure you that you're making a smart, active decision. But that reaction is what keeps you poor. Simple works. Complexity is what makes money for financial advisors. Let me address the specific what-ifs I know you're thinking. What if I invested right before a 50% crash? You'd lose 50%. But if you invested another 50% during the crash, you'd buy twice as many shares at half price. In a recovery, you'd be up 100% on that second portion. You'd be up way more than if you'd never invested. The math of continuing to invest through crashes beats the math of avoiding crashes. What if the market keeps going down indefinitely? It won't. This has never happened in modern history. The 2008 crash was the worst since the Great Depression. It recovered. COVID was worst-case scenario for surprise crashes. It recovered. Every single crash in history has been followed by a recovery. The recovery is what you miss when you sit in cash. What if I miss the timing right at the top and it crashes 50%? Even the worst-case crash in the last 100 years, 2008 at 57% down, still results in significant gains over 20 years if you hold through it and keep investing. You're comparing the worst 6-month outcome to the average 20-year outcome. The long-term math always wins. What if my emotion overcomes me and I sell during the crash anyway? Then you've got a different problem than waiting for the crash. Dollar cost averaging helps because the decision is already made for you. You can't override an automatic investment. You can override a decision to invest. What if the market is genuinely overvalued and a crash really is coming? Markets are overvalued from the perspective of future returns about 60% of the time. But overvalued compared to what? The timing problem again. You'd need to be right about when, not whether. Everyone agrees the market will crash eventually. Nobody can predict when. The real pattern is, waiting for a crash that comes means you get the crash, but then you need to time getting back in, which is another decision. Most people miss the recovery. Waiting for a crash that doesn't come means you lose years of gains. Even if the crash eventually comes, you've lost so much ground that you have to recover from two things: the crash and the years of losses while you waited. Here's something behavioral finance researchers discovered. Waiting feels like you're avoiding risk. You think, I'll avoid the crash by being in cash. I'll feel safe. Your brain releases dopamine for making a defensive move, but you're not actually avoiding risk. You're trading one risk for another. Market risk. The market will drop 20% sometime in the next 5 years. Recoverable. Yes, always has been. Timing risk. You'll predict correctly and get back in before the recovery and not sell again. Probability, less than 5%. You're choosing the harder path because it feels safer. That's psychology, not logic. This is why people need the data. The data overrides what feels right. The data says, boring holding beats exciting timing. Waiting feels safe but is expensive. Staying in the market feels scary but is profitable. If you can get past the feeling and follow the data, you'll have more money. That's not opinion. That's mathematics. Here's what most people miss: the hidden cost of being too early. Say the market will crash in 2027. You're right. But let's do the math. Scenario 1, invest now. Up 8% in 2026, up 12% in 2027 before crash. You're up 21%. Crash drops you 30% to minus 10% from start. Recovery gets you to plus 35%. Scenario 2, wait in cash. Earn 9% total, 4.5% 2 years. Then crash hits. You buy at bottom. Recovery gains 30%. You're at plus 30%. But you missed the $21,000 gain from scenario 1. You were right about the crash. You still came out behind. This is the actual trap. Even when you're right, you're wrong. The gains before the crash you miss are often bigger than the crash itself. Average crash recovery time, 4 months. Average bull market before crash, 24 plus months. You're trading a 24-month period of gains to avoid a 4-month period of losses. Plus, you miss the recovery. The math doesn't work unless you're predicting a 50% plus crash with a 5+ year recovery. Those are once in 50 years events. You're planning your entire strategy around something that almost never happens. That's not prudence. That's paranoia. The average person reading this has $20,000 to $50,000 in cash, earning 4.5%. They're thinking, I'm being smart. I'm waiting. But the math says waiting costs you $500 per month in foregone gains. That's $6,000 per year. $60,000 per decade. Across 40 years of working life, that's $240,000 in pure opportunity cost, not counting compound interest. Across 40 years with compound interest, that's closer to $500,000 to $1 million, depending on what market returns look like. You're literally turning $50,000 into $0 to avoid a 20% drop that would hurt for 4 months. The person isn't wrong about the market potentially being overvalued. Markets probably are overvalued about 40% of the time. But the strategy of waiting doesn't work because you can't time it well enough. If you're sitting in cash right now, calculate what your money would be worth if you just invested it 1 year ago. Imagine working 10 hours overtime to earn that money. That's how expensive waiting is. The data is clear. Time in the market wins. Timing the market loses. Not sometimes, almost always. So what do? Option 1, you're already invested. Great. You know the answer. Time in the market beats timing. Option 2, you're sitting in cash and this convinced you. Don't invest everything tomorrow. Start with what's comfortable. $100 per week, $500 per month. Set it automatic. Forget about it. Check in 5 years. The stress disappears. The gains appear. Option 3, this hasn't convinced you yet. Write down the amount waiting to invest. Write down today's market price. Set a reminder for 1 year from now. Check the price then. Calculate what that money would be worth. See if you're comfortable with that opportunity cost. Most people aren't. The hard part isn't the math. It's accepting that boring is better. Accepting that you don't need to feel smart to be smart. Accepting that the best financial decisions often feel wrong in the moment. If you can get past that, wealth becomes clear. Invest consistently. Stay invested. Let time work. You don't need genius. You need to stop getting in your own way.